All right, let's dive into one of the most important investing books ever written, Benjamin Graham's The Intelligent Investor. Now, forget all the noise about day trading and trying to get rich quick. This is about timeless wisdom for what Graham called the defensive investor. That's anyone who wants to build wealth step by step and, maybe most importantly, sleep well at night.
Graham kicks things off with this brilliant paradox that gets right to the heart of how we think about money. Our feelings are almost always the exact opposite of what's really happening. You see, back in 1949, when stocks were dirt cheap and a huge bargain, everyone felt scared. They felt unsafe. But fast forward to the 1960s, after a massive bull market made everything expensive and risky, people felt totally safe. It's this mental trap that gets so many of us in trouble.
So, if our emotions are basically trying to trick us, you might be wondering, why should a safe, defensive investor even mess with stocks at all? Well, Graham says there are two huge, undeniable advantages, but they come with one giant danger that can completely wipe out all the good stuff.
Okay, advantage number one, stocks protect you from inflation. You know, that silent thief that eats away at the value of your cash. A good company can just raise its prices, so its profits keep up and your investment doesn't get left behind. And second, and this is the big one, stocks have just historically provided a much higher return over the long haul. That's from a combination of dividends and the company reinvesting its profits to grow even bigger.
But here's the catch, and it is a huge one. You could find the absolute best company in the world, a total game changer, but if you pay too much for its stock, you can still lose a ton of money. Overpaying is the single biggest mistake. It's what turns a smart investment into a risky gamble, and it cancels out all of those natural benefits we just talked about.
And if you want to see just how devastating overpaying can be, look at this number, 25 years. That is how long it took the stock market to get back to where it was before the massive crash of 1929. A quarter of a century, just to get back to even. For most people, that's their entire working life gone.
So, the big question is, how do we get all the good things about stocks without falling into that trap of overpaying? Well, this is where Graham gives us a super clear defensive playbook. He boils his whole philosophy down to 4 simple but really powerful rules. Okay, rule number 1, diversify. Pretty simple. Don't put all your eggs in one basket. Owning 10 to 30 different stocks spreads out your risk. Rule 2, stick with the big guys. We're looking for large, well-known companies with solid finances. This isn't the place to be hunting for lottery tickets. Third, look for a long history of paying dividends. This is your proof that a company is durable and has made it through tough times before. And finally, the golden rule. Control the price you pay. Don't ever get so excited that you pay more than a reasonable multiple of what the business actually earns. That last one is your ultimate shield.
Now, these rules aren't just random suggestions. They're specifically designed to protect you from the temptations that trip up most investors. Let's look at the 2 biggest traps these rules help you sidestep.
The first trap is the allure of growth stocks. You know, the hot companies that everyone expects to take over the world. The problem, as Graham points out right here, is that because everyone expects them to grow so fast, their stock prices get bid up to insane levels. And that high price tag basically turns the investment into a massive speculation.
Texas Instruments is a textbook case of this. Over 6 years, its profits grew almost tenfold, which is amazing. But its stock price, it exploded by more than 50 times. The stock's price was growing 5 times faster than the actual business. So when earnings finally took a little dip, the whole house of cards came down, and the stock crashed 80%. The hype just got way ahead of the reality.
Okay, the second big trap to avoid, new issues or IPOs. The key thing to understand here is the basic setup. Companies go public when conditions are absolutely perfect. For them, the sellers, it usually means the market is hot, there's a ton of excitement, and prices are sky high, which is the exact opposite of a good time for a defensive investor to be buying.
I mean, this story of VA Linux is just wild, but it's a perfect example. The insiders, they got their shares for $30. By the time you or I could buy it on the open market that morning, the price was nearly $300. And just a few years later, it was trading for a little over $1. The public, who bought into all that hype, got absolutely crushed.
So, if trying to pick individual stocks is so full of these dangerous traps, what is the ultimate defensive strategy? Well, Graham has a beautifully simple, almost mechanical approach that builds wealth and completely removes fear and emotion from the equation.
It's called dollar cost averaging. All you do is invest a fixed amount of money, say $100, at regular intervals, like every single month, no matter what. And here's the magic. This system forces you to be a smart investor. When prices are high, your $100 buys fewer shares. But when the market is crashing and everyone else is panicking, your same $100 automatically buys more shares right when they are on sale. It's brilliant.
And the power of this strategy is just stunning. Look at this. If you had invested a big chunk of money right before the Great Depression, you would have gotten hammered. A decade later, your $12,000 would be worth about $7,000. But if you had just put in $100 every month through that entire brutal decade, you would have ended up with over $15,000. You would have actually made money during the worst crash in history.
And you know what the best part is? Today, this is so incredibly easy to set up. By automating monthly investments into a few low-cost diversified indexed funds, you create what you could call a permanent autopilot portfolio. You're just buying the whole market, a little bit at a time, month in and month out, with zero guesswork. And once you're on autopilot, you're free. When someone asks you, hey, what's the market going to do next? You can give them the most powerful answer in finance. I don't know and I don't care. Because you don't have to know. You don't have to predict anything. Your system just works.
Which brings us right back to where we started. Graham's whole philosophy really comes down to this. The biggest risk in investing isn't the market, it's not our stocks. It's us. It's our own behavior. By having a disciplined process, we protect ourselves from the market's craziness, but more importantly, we protect ourselves from our own worst instincts. So the question isn't really if the market is risky, but whether we can manage our own behavior inside of it.